Welcome to Vision Capital's third quarter 2026 investment outlook. I'm Jeff Schmidt, Director of Investments. Stock markets generated strong first half returns across the globe. The AI-heavy Asia-Pacific region led the way with a 68% return in Korea, 46% in Taiwan, and 37% in Japan during the second quarter alone. But traditional stocks are performing well too. The average U.S. stock returned 19% in the first half as small cap stock returns exceeded large cap stock returns. In fact, broad small cap indexes returned 21% in Q2 versus 16% for the S&P 500. A natural recovery in cyclical industry is fueling small cap performance. But the ongoing artificial intelligence transformation remains the driving force of stock returns in this era. Earlier appreciation in GPU developers such as NVIDIA and model builders, including Google, had given way to sudden and explosive appreciation in traditional memory and CPU chip makers, such as Micron. A nearly instantaneous surge in memory demand versus static supply has caused memory prices to surge 800% in only 9 months. Long-forgotten semiconductor companies of the early 1990s are experiencing the best financial results of all time, with some memory producers reporting operating profit margin far higher than the most profitable companies in history. Debates about overspending on AI infrastructure are becoming more widespread, despite those stocks driving nearly all the return in the S&P 500 over the last year. The last couple of months have witnessed news of companies implementing AI usage caps for employees, large owners of compute leasing out excess capacity, and mega caps with pristine balance sheets selling new equity. Regardless of any excess in AI spending or stock valuation, the installed infrastructure of compute is the bedrock of future innovation and productivity gains. Businesses will achieve greater scale and smarter ways to pursue customers. However, persistent inflation is dampening the prospect of these benefits, with the Fed's preferred gauge of inflation settling in well above target. This means that near-term interest rates might stay higher longer into the future to restore price stability. Near-term interest rates affect corporate bank loans, car loans, equipment financing, home equity lines of credit, and any other variable interest borrowing. As a result, monetary policy over the next couple of years might work against a naturally expanding economy. Longer-term interest rates will be supported by a growing pile of debt issuance from the public and private sectors. Federal deficits during expansionary periods, followed by excessive pandemic-era stimulus, are forcing the U.S. government to issue around $30 trillion in debt per year, growing to nearly $39 trillion by the end of the decade. The AI build-out is causing private sector debt issuance to soar, while AI model builders such as Anthropic and OpenAI plan public offerings at $1 trillion valuations. The savings era, which followed the great financial crisis, has suddenly turned into an investment era where the demand for loanable funds and capital formation exceeds the supply of loanable funds. Unlike the savings era, the current environment includes shrinking central bank balance sheets that were a primary source of funding for government debt markets. Tax stimulus, a natural recovery in cyclical industry, clarity in international trade, and an employment-focused Fed supports a positive economic outlook. But the compounding effect of stock returns during the last decade, greatly amplified by AI excitement during the last 3 years, reduces the potential for strong stock returns in the intermediate future. We have decreased risk in portfolios twice in 2026, early in the year and again in early summer. We are underinvested in the AI theme relative to market indexes like the S&P 500. Our exposure to long-term interest rates is lower than the bond market, as our corporate and government portfolios contains nearer maturity dates. Thank you for watching, and we look forward to speaking with you again in October.